We are now entering the final countdown to the most profound market dislocation in precious metals history. It is January the 2nd, 2026, and in the past 72 hours, we have witnessed gold shatter through 4,391 per ounce, while silver physical premiums have detonated to levels unseen in modern trading. Americans walking into coin dealers today are facing premiums ranging from 12% to 18% over spot on American silver eagles, with delivery delays extending into February. This is not a supply chain hiccup. This is the beginning of a market fracture that will split reality itself into three distinct pricing universes. Ladies and gentlemen, this is your capital markets warning from Capital Key. Let me be brutally clear about what is happening right now in precious metals markets. We are watching three completely separate realities emerge, and most investors have no idea which one is even real anymore. Reality number one is the paper futures price trading on COMEX, where silver sits at roughly 53 per ounce after the December 31st margin liquidation. Reality number two is the dealer wholesale market, where American silver eagles are being quoted at premiums 15% above spot, with some regional distributors hitting 18% markups. Reality number three is what I call the street price, where individual buyers trying to secure physical metal today are paying between $62 and $68 per ounce for 1 ounce rounds, depending on product and location. Do the math with me. If COMEX says silver is $53, but you cannot buy a single ounce below 62, then which price is the lie? This is the arbitrage death zone. The mechanism that used to keep paper and physical aligned has been severed. When spreads reach 15% to 18%, and nobody can close that gap through delivery, then price discovery itself has failed. What happened on December 29th was not a correction. It was a controlled demolition. The CME Group implemented their second margin hike in 7 days, raising silver initial margin requirements by 30% from $19,000 to $25,000 per contract. Silver got slammed 11% intraday in what looked like capitulation. But here's what the television analysts will not tell you. December was the single largest delivery month for COMEX silver in over 3 years, with 12,946 contracts standing for delivery, representing 64.73 million ounces of physical metal demanded out of the exchange. That is not speculation. That is a run on the vault. And the CME responded exactly the way a fractional reserve system responds when customers ask for their deposits back. They changed the rules. They made it prohibitively expensive to hold long positions and forced weaker hands to liquidate. This was not about managing volatility. This was about managing a liquidity crisis that most market participants do not even realize is underway. Now let me show you the numbers that should terrify anyone holding paper silver promises. Registered COMEX silver inventories as of December 31st, 2025, stood at 128.16 million ounces. That is the lowest level since February 2025. But that number alone does not capture the full picture. COMEX inventories have fallen nearly 70% since their 2020 peak. We are talking about a drainage rate that has been relentless for 5 consecutive years. Meanwhile, global silver markets have operated in structural supply deficit every single year since 2021, with demand exceeding mine supply by hundreds of millions of ounces annually. Who has been filling that gap? Inventory drawdowns. And those inventories are now approaching depletion in the venues that matter most for price discovery. Shanghai Futures Exchange, silver stocks have collapsed to record lows, triggering force majeure warnings from analysts who understand what happens when the world's largest physical silver market runs dry. This is not a temporary imbalance. This is inventory exhaustion at the exchange level, which means the institutions that guarantee delivery are running out of product to deliver. Behind the scenes, there's panic at the institutional level that the mainstream financial media refuses to acknowledge. On January 1st, 2026, China implemented sweeping export restrictions on silver, requiring government licenses for all outbound shipments. Only 44 approved companies are now authorized to export silver from the world's largest refining hub. Elon Musk himself issued a public warning on December 28th, stating China restricting silver exports is not good, specifically citing impacts on industries reliant on silver inputs, including solar panels, electric vehicles, and electronics manufacturing. This was not some speculative tweet. Musk understands that Tesla and SpaceX both depend on reliable silver supply chains, and those chains just got choked. The timing of China's move is no coincidence. Beijing is watching Western exchange inventories collapse and recognizing that physical silver is a strategic industrial commodity, not just a monetary metal. By controlling exports, China is ensuring domestic supply for its own green energy build-out while forcing Western manufacturers into a bidding war for dwindling above-ground stocks. We are entering the early innings of resource nationalism in critical materials, and silver is the opening salvo. Now let me break down the industrial demand side, because this is where the true supply crisis becomes impossible to ignore. Silver industrial consumption hit an all-time record of 680.5 million ounces in 2024, and that number is accelerating into 2026. Solar panel manufacturing alone now accounts for approximately 30% of total industrial silver demand, with each photovoltaic panel requiring roughly 20 grams of conductive silver paste. Global solar installations are projected to continue expanding at double-digit growth rates through 2030, driven by government mandates and private sector decarbonization targets. The Silver Institute estimates automotive industry silver demand will grow at 3.4% compound annual growth rate from 2025 through 2031, with electric vehicles consuming 25 to 50 grams of silver per vehicle for battery contacts, motor assemblies, and charging infrastructure. On top of that, 5G network buildouts and data center expansions are driving incremental demand for silver-bearing connectors and thermal interface materials. This is non-discretionary demand. These industries cannot substitute away from silver without sacrificing performance, and they will pay whatever price is necessary to secure supply. And here's the kicker. Mine supply is completely inelastic. Over 70% of silver comes as a byproduct of copper, zinc, and lead mining, which means silver production is governed by base metal economics, not silver price. Even if silver hits $100 per ounce, new primary silver mines take 7 to 10 years to bring online. There is no cavalry coming. The official spot price you see flashing on financial news networks is increasingly detached from the reality unfolding on the ground. Walk into any bullion dealer in America today and ask for 100 ounces of silver eagles for immediate delivery at spot plus $2. They will laugh you out of the building. Premiums on retail silver products have exploded, with American silver eagles trading at $12 to $15 over spot per ounce, depending on order size and dealer. That is a 23% to 28% markup on a $55 paper price. Generic rounds are seeing $8 to $10 premiums. Delivery times have stretched from same week to 4 to 6 week delays on bulk orders. And these are not obscure mom and pop shops. These are the largest authorized bullion distributors in the United States, reporting unprecedented tightness in wholesale supply chains. Meanwhile, go online and check live dealer buy prices. Most are offering $6 to $8 below spot to buy back your silver, even though they are selling 15% above spot. That spread is not greed. That is liquidity stress. Dealers are telling you they cannot source replacement inventory at reasonable cost, so they are widening bid-ask spreads to throttle selling and conserve stock. This is exactly what happens in the early stages of a shortage, when the paper market diverges from physical reality and the people holding physical metal stop selling at paper prices. Let me walk you through what happens next in 3 distinct phases, because this crisis is following a predictable trajectory and we are only in phase 1. Phase 1 is the divergence. That is where we are right now. Paper prices remain somewhat suppressed through exchange margin manipulation and short-side positioning, while physical premiums explode and delivery delays extend. Retail investors start noticing the disconnect and begin front-running the shortage by locking in orders at elevated premiums. Institutions holding large silver positions in unallocated accounts or ETF shares quietly start converting to allocated physical storage or taking delivery. This phase can last weeks to months, and it creates the illusion that the system is still functioning because futures markets remain liquid. But underneath the surface, the physical float is evaporating. Phase 2 is the squeeze. This begins when a major player, either a sovereign wealth fund or industrial consumer, publicly demands delivery of a size that exceeds available registered inventory. The exchange either defaults through cash settlement or sources metal at prices far above the official close, triggering a cascading revaluation across all silver instruments. Premiums that were 15% suddenly hit 40% or 50% as panic spreads. ETFs trading at net asset value suddenly trade at massive premiums or suspend creation units because authorized participants cannot source the underlying metal. This is the phase where price discovery breaks completely and the paper market loses credibility. Phase 3 is the reset. Official prices reprice violently higher to reflect true physical scarcity. Futures markets either collapse in volume or become purely cash-settled vehicles disconnected from physical settlement. A new two-tier market emerges where paper claims trade at deep discounts to physical metal, and the only prices that matter are bilateral negotiated prices between physical holders and desperate buyers. Governments may intervene through export controls, emergency stockpile releases, or forced allocation schemes. By the time we reach phase 3, the wealth transfer is complete. Those who held physical metal bought at today's prices will have preserved and multiplied purchasing power. Those who trusted paper promises will be left holding worthless contracts settled in inflated currency. This is not speculation. This is pattern recognition. We have seen this movie before in other commodity markets, and the ending never changes. In 2008, rhodium went from 10,000 per ounce to near zero when industrial demand collapsed, but then rebounded to $29,800 in 2021 because supply had been permanently destroyed and demand returned. Palladium spiked to $300-400 in 2022 when Russian supply disruptions hit global auto manufacturing. Uranium spent a decade in the wilderness after Fukushima only to triple in 18 months once utilities realized existing mines could not meet reactor demand. Every single time the same sequence plays out. Structural deficit meets inelastic supply meets geopolitical shock, and the result is violent repricing. Silver is following this exact script, except the deficit is deeper, the supply is more constrained, and the industrial dependency is greater than any previous commodity crisis. The only difference is silver also carries 5,000 years of monetary history, which means when the reset arrives, it will not just be industrial buyers scrambling for metal. It will be central banks, sovereign wealth funds, and retail investors worldwide recognizing that silver is the most undervalued strategic asset on the planet. I want you to understand what Goldman Sachs, JP Morgan, and UBS are quietly telling their institutional clients while the media talks about corrections. Goldman Sachs has a $4,900 gold target for December 2026, driven by central bank purchases averaging 70 tons per month. JP Morgan is calling for gold to average $5,050 per ounce in Q4 2026, rising toward $5,400 by late 2027. UBS sees $5,000 gold by Q3 2026, with upside to $5,400 under stress scenarios. These are not fringe analysts. These are the largest banks on earth telling you the monetary system is being repriced in real time. And here is the part they will not say out loud. If gold is being revalued 60% to 80% from its 2024 average, then silver, which trades at a historic gold to silver ratio of 75 to 1, is catastrophically mispriced. The long-term average ratio is 60 to 1. The natural geological ratio is 17 to 1. At current gold prices, a reversion to even 60 to 1 would put silver at $73. A move to 50 to 1 puts silver at $88. And if we see any kind of supply shock that tightens the ratio to 40 to 1, you're looking at $110 silver with gold at $4,400. These are not moonshot predictions. These are mathematical outcomes based on historical mean reversion and current fundamentals. So what does this mean for you as an individual trying to protect wealth in a system that is fracturing? It means you cannot wait for confirmation. By the time silver shortages hit mainstream news, the premiums will be 50%, and delivery will be measured in months, not weeks. It means you cannot trust paper proxies. ETFs may track price, but they do not guarantee physical delivery, and when the squeeze comes, those shares may be cash settled at prices you did not agree to. It means you must take possession of physical metal, stored outside the banking system, in a jurisdiction you control. It means you recognize that gold and silver are not investments. They are insurance against the exact scenario unfolding in front of us, where currency debasement meets resource nationalism, meets industrial shortage, and the result is a scramble for hard assets that hold value independent of counterparty promises. The Americans who are missing this story right now are the ones watching COMEX tickers and assuming silver at $53 means they can buy silver at $53. They cannot. That price is a fiction sustained by leveraged paper trading and exchange manipulation. The real price is what you pay when you walk into a dealer today, and that price is already 15% to 20% higher and climbing every single week. We are now in the final window before the market acknowledges what the physical buyers already know. Silver is not abundant. Silver is not cheap. Silver is the most undersupplied strategic metal in the global economy, and the paper market that has suppressed its price for decades is running out of physical metal to deliver against its promises. When that reality breaks into public consciousness, the repricing will be violent, immediate, and irreversible. Gold breaking $4,300 is the headline. Silver premiums exploding 15% is the warning. The hidden shortage Americans are missing is the wealth transfer event of this generation. This is your capital markets warning from Capital Key. The system is showing you the cracks. The only question is whether you will act before the dam breaks or wait for the flood. Like, subscribe, and share this message with anyone who still believes paper prices reflect physical reality. The warning is delivered.